please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good morning. Welcome to Bazaar Morning Call. I'm Lata and with me are Anuj and Sonia. Well, I think the expected happened both abroad and in India. The way in which the Fed statement shaped up did not hold too many surprises. Maybe somebody would argue that the dot chart indicates a little more hawkishness, but 4 more hikes by end of 2019. The market is pricing a little less, but this is on expected lines. The important point is crude as well is at 82 and a quarter. So with this hawkish Fed and crude, how much impact will our import duty hike have on the rupee? Well, I would venture to say, and of course we will have a lot of experts discussing this, that the import duties themselves may bring about 500 million, fewer imports into the country. So it doesn't really move the needle so much in terms of the current account deficit. Expectations are between 80 and 90 billion dollars is the current account deficit. It probably moves by, $500 million or 1 billion at the most. But there will be a lot of impact because the rupee has depreciated. This duty hike itself is not going to make a big difference. But I think it's going to make a huge sentiment difference that the government is going the whole hog to ensure that the current account deficit is kept in check. So it's a big sentiment positive in spite of crude being higher and the Fed sounding hawkish. I think today the rupee should, at least in the early morning hours, be sentiment positive. And my sense is maybe it will even get off the headlines. It already has got off, but it's quite possible that it won't be so much of a talking point because 73 has been so well defended, and there's probably a rate hike from the Reserve Bank as well. My sense is that after this initial activity around the consumer durable stocks, my sense is focus is again going to return to the NBFCs. That is the unresolved problem. Though much of it has played out, we will again talk NBFCs today.
Okay, so the sentiment on the rupee could improve today, but for the equity markets, there are still many negatives on the sidelines, Absolutely. Right? I mean, the US markets were under pressure after that Fed hike that we saw yesterday. For us, FII sold almost 800 odd crores. Crude continues to be at a 4-year high. It's F&O expiry today, so things could go either way. I mean, this series itself, the Nifty has lost more than 600 points. And yesterday, too, we ended in the red despite that intraday recovery that we saw. So, give and take everything, we're not out of the way as far as volatility is concerned for sure. Anuj, morning. We've been talking about this 200-day moving average of 10,750. At least it's held for now. Do you get a sense that the support could hold in the near term? I mean, considering it's F&O expiry today as well?
Yeah. Morning, Sonia. I think the trade to try today is to try a long bank trade, because today, there's a good chance that the market gets the message that more measures will be announced or something will happen. 73 is clearly the pain point for the government on the rupee. It's not been breached intraday at any point. Every time it's going there, there's an attempt. So, and the bank Nifty has been sold off quite a bit. So today, I think the risk reward perhaps is in favor of trying a long bank Nifty trade, perhaps via the call options, because you have expiry today, because the market's gone through a bit of a consolidation after a big decline, and as of now you'll have to believe that the Nifty has made some kind of bottom at 10,950. Now, the only problem is small and mid caps are in a big pain once again. In fact, the small cap index has made a fresh 52-week low. We haven't noticed that, but in the recent move it's made a fresh 52-week low. The mid cap index has moved within 0.5% of a fresh 52-week low, so that we had that big low and then the July to August rally, that's been entirely sold into in the mid caps and small caps. That's a bit of a problem point. So portfolios are in pain once again. A lot of people say, what are you talking about? The index is only down 6-7%. That's not the way to look at things. The index, we all know, is a few stocks here and there doing their bits. The broader market is in a pain. Ask people with portfolios, they will tell you that they are in pain right now. So that is a problem point. Even for the index, you would want to test the bottom again to perhaps test the strength, but today might not be that day. You may want to just play on the expiry today, and then in October perhaps test to see if that 10,950 holds or not. For me, I think the indications were there yesterday. The way IT index was falling, TCS yesterday was one of the biggest losers. Perhaps the IT index is now ready for correction. It's the most overcrowded trade. It may correct sharply from here on. May not change the overall texture, might still be buy on dips, but for now, near term, I think the trade to play perhaps could be to take some money off IT and try some money, trade on the bank nifty today and see how that works. Your risk reward is in your favor because the recent low is your stop loss.
Bank nifty may be advantaged because it has these marquee retail banks like HDFC Bank, IndusInd Bank and Kotak Bank. But I don't think the pain on NBFC goes.
I'm not.
It is not.
Yeah, exactly. I think the bank nifty. That's what I said. The bank nifty, pure banks. NBFCs no, because this all over the place.
No, actually,
really
what we have, yesterday we had the mutual fund awards, and the big point that everyone realized is none of the mutual funds realized how much they are exposed to the NBFCs, debt plus equity included. You work in silos and you don't take the big picture. So the exposure of the mutual fund industry, if you included debt and equity, could be such that they can't tank up anymore. Maybe they will not sell in a hurry, but difficult to tank up at this juncture because they're overexposed. So that part will continue to bedevil us and bother us. And then, of course, as you say, I don't see IT once again having that kind of leadership because the determination, 73 is priced into IT stocks. So nothing more is coming over there, and therefore there could be profit taking, which doesn't leave too many candidates for taking the index forward, except, as you say, the 3 or 4 retail banks.
Okay, in fact, we'll get you some views. A lot of brokerages have downgraded India as well, but don't lose sight of how much we've lost already in this series. The Nifty PSU Bank Index is down 17% in the series gone by. So the month of September has definitely not been a good one for the bulls. But let's take a look at what our wise experts have to say as we head into trade this morning. Derek Higa of William O'Neill says that they have downgraded India to a downtrend on Monday. That's September 24th, after the Sensex fell below its 100-day moving average for the first time since March. He says investor sentiment remains jittery after a recent default by IL&FS, along with issues at Yes Bank. He also says that they have become more bearish on India amidst uncertainty surrounding financial industry turmoil and significant deterioration in the index over the last 4 weeks. He says the next level of support is near the 200-day moving average.
Okay, that's a rather dreary call. Here's more opinion on global markets. Joanne Go, Asia strategist at DBS, says markets find temporary relief with trade war-related headlines in EM currency risks less distressing. She says oversold positions amid low valuations could see Asian markets recovering from lows. However, she adds India is an underweight as a low base effect will start to fade and policy response to a weak rupee could slow growth. She says twin deficits, higher oil prices against 2 more US rate hikes this year, and unresolved emerging market crises are likely to continue to exert pressure on the rupee.
All right, speaking about the rupee, today, of course, the sentiment on the rupee will be positive because of the announcements that were made. 70 to 60 is how we closed yesterday. Pramit Brahmabat of Veracity says that the US Fed hiked interest rates by 25 basis points as anticipated. He expects the rupee to trade with a positive bias today, and the dollar-INR pair would trade in a range of 72 to 72.5 for the trading day.
About 25 pice is what everybody was expecting the dollar to open cheaper. But then crude at 82.04 or whatever is going to take away some of the cheer after it opens. Now to bonds. Ajay Manglunia of Edelweiss says the bond markets have been relatively stable despite the renewed uptick in crude prices as the rupee has not depreciated further. He says hopes of continued open market operations liquidity injection will keep gilt yields supported even as the market consensus has shaped towards a rate hike by the MPC next week. However, the possibility of a December rate hike by the US Fed after yesterday's meeting might induce some volatility today. Expects 10-year benchmark bond yield to trade in a range of 8.04, 8.12. I think it'll lie there. There's some steadiness in the yields.
Okay, yes, yesterday was a decent day for bond market. Let's talk about global cues though. Here's Rima with the world view.
Good morning, guys. First, let me run you through all the headlines coming out of the Fed. The Fed has hiked rates by 25 basis points on expected lines. It's taken the rates to 2.25%, similar to what we had in April 2008. They've guided for 1 hike in 2018. That's likely in the December policy, and 3 in 2019. The stance of the monetary policy remains accommodative, has now been removed. They're also more optimistic and upbeat on U.S. growth. So for 2018, they've upped the assessment for their GDP from 2.8% to 3.1%. For 2019, they've upped it by 10 basis points, their growth assessment to 2.5%. And they say the long-term growth is about 1.8%. And they've introduced it for 2021, which means in 2021, they're expecting US GDP to be at 1.8%. If you look at the equity markets, the Dow slipped a little more than 150 points from the top of the day. It ended down about 100 points. The Nasdaq and the S&P 500 also in the red. The US 10-year yield slipped from levels of 3.10 to 3.05. As Jerome Powell said, that inflation is unlikely to surprise on the upside. European markets too had a positive finish. The big gainer there was the French index with a rally of about 0.5%. Asian markets have a mixed picture, so let's get that up. A little bit of red for the Chinese and the Japanese markets, green for the others. Crude oil prices continue to hover above that $82 per barrel mark. We had that surprise build up in crude inventories, but despite that, still higher. And the dollar index continues to hover around that 94.3 mark. SGX Nifty currently in the green, up about 0.25%.
Thank you, Rima, for that. Well, we have a couple of guests joining us now. Kathleen Jingol, the MD of Cartica Capital, and Jeffrey Dennis, the head global emerging market strategist at UBS, is with us to discuss all the cues that we've got overnight, both global and local. Kathleen, let me start with you first. You've been a big bull in the Indian markets for a while, but we've had to deal with multiple headwinds over the last many weeks and months, whether it's the weaker rupee or higher crude. We now have the government taking some steps in order to resolve these issues. Would you be hopeful about a recovery in the Indian markets, or have you started to, started to become a bit cautious now on India?
No, our stance have not really changed. I mean, our time frame is longer term, is 2-3 years or even beyond. So on that time frame, we still see a lot of opportunities in India. So if anything, we would use this correction as an opportunity to add to our positions. In terms of the recovery, I think you mentioned the hawkish Fed, and I kind of read it differently, the announcement today. I think the fact that they're signaling that they're closer to the neutral rate, that means that from here on, the Fed will be more cautious to raise than it has been in the past, which I think mean that the dollar could be turning in the near to medium term. There is some light at the end of the tunnel. The dollar gets a bit weaker, and that would be a really big boost for emerging markets.
Okay.
And including India.
All right. Let's see if Jeffrey shares this view of both weakness in the dollar and relief for EMs. Would you, Jeff? First of all, good evening, and thank you for joining us. But is this going to mean slightly weaker dollar, or is it the other way around?
No, we agree with the previous speaker. We think the dollar is going to go lower, and we think that's going to be a trend that's going to be in place over the rest of the year and even for much of 2019. So we agree that's going to provide some relief for emerging markets. Now, our read on the Fed today was they took out the word accommodative, which I think was interesting. We were surprised that they didn't talk more about the downside risks to growth from the trade situation. And actually, our economists think the U.S. economy is going to slow quite sharply in both Q4 and Q1. And they think actually their base case of them is that the Fed doesn't raise rates in December. So if any of that comes to be true, I agree that I think the dollar is going to come down. And that's going to provide some support for the emerging markets going forward. So I think it was a reasonably constructive Fed statement, FOMC statement today for the long-term outlook, medium-term outlook for EM.
Okay. Kathleen, good morning. The other problem for Indian market, apart from dollar strength over the last few months, has been the strength in Brent crude. In fact, as we speak, we are again above 82. There's some forecasts of 90 plus on Brent crude. How big a risk is that for India in particular?
Well, I would argue that this is one of the bigger risks for India, for sure. I would mention 2 points that could alleviate some of the pain. First point is, if we are right and the dollar will turn, then at least in rupee terms, the oil price hike will be less of a pain than it has been in the past 1 year. The second point I would make is that we are very encouraged to see the economy finally, finding some good growth engines, and productivity is increasing. And with increasing productivity, it's somewhat easier for the economy to manage higher oil prices than it has been in the past, let's say during the previous oil price peak.
Okay. Well, would you not worry that after all the hike in import duties, Kathleen, which the government announced yesterday, and a possible rate hike, are all intended actually to slow imports, to slow consumption, because they have created a problem of current account deficit? Therefore, would you want to relook growth numbers at all?
Well, I'm not debating that growth might come off a little bit. I mean, the latest print was, very, very high, and the number that may not be sustainable, probably not sustainable. But still, we see signs that there is economic momentum, and I don't think that import duties or the rate hike that's being done so far will do all that much damage to this recovering economy. I mean, consumption is one engine that's been firing for quite a while now, where we are becoming a bit more optimistic that finally investments, and specifically private investments, will come back and help the one engine of consumption with another engine to propel this growth and make it sustainable for a longer period of time.
Okay. Jeff, Kathleen did mention that this is a good opportunity to buy into the Indian markets. Would you concur with that view? I mean, is this a time to be putting some money to work in the Indian markets? And if yes, yeah, go ahead.
Sorry, yeah, we don't think so in the short term. I mean, I certainly agree that the long-term growth outlook in India is extremely good, and I agree with Catherine that, in fact, the policy measures that have been taken now are not really going to hurt the growth outcome in the long term. And this is an economy which is growing clearly significantly stronger than any other emerging market economy, and that's worthwhile pointing out, I think. And frankly, I think for the markets and their sense of confidence ahead of next year's election, I think tightening of monetary policy, albeit in response to obviously, the stronger dollar and a weaker rupee earlier in the year, I think it's a sort of policy move that people would like to see. We also want to see if there's going to be any follow-through on the fiscal side. So there's a confidence-building element about that as well. Where we are more concerned is we just think the market is too expensive at the moment, and our Indian strategists have continuously been arguing that the earnings numbers have been disappointing. So I think we're probably going to have a bit more softness in the near term. I think, in other words, there may be a better opportunity, down the road, short term, than there is today. We think there could be some more selling pressure in the short term, in other words.
All right, Jeffrey, we leave it there. Thanks a lot for joining us. Kathleen, I'll request you to stay on for a bit. We have Arvind Sangar also joining us now from Geosphere Capital. Arvind, good morning.
Good morning.
So how do you see the situation? There's a belief that all these duties would put some kind of near-term cap, but then the pessimists would argue that would mean that the problem is really deep and this is not going to put a long-term solution in place. Your thoughts on dollar rupee and Indian market after the kind of moves that we have seen?
Well, I mean, unfortunately, it's putting a Band-Aid on a wound, and it's a big wound and it's a small Band-Aid. And the problem is twofold. One is that you have oil, which is clearly headed higher, and it's already back to levels which we haven't seen since 2014. And in our opinion, and I've been saying this for a few months on your channel now, that oil is headed higher, and as the Iran sanctions continue to bite, it's going to get worse before it gets better. So that's one obvious headwind. The second headwind is obviously, the Fed is clearly on a pretty solid rate path, which is going to create a headwind for fund flows, not just for India, for other emerging markets. And the third, and I think the most important and the most recent one, which I think really does raise new challenges, is that the tightening of liquidity conditions for NBFCs is not going to disappear, even if a bailout happens for IL&FS. And if you look at three legs of the liquidity stool for Indian corporates, the one leg of the PSU banks has been broken for a long time. And the two legs that were filling up the gaps were private sector banks and NBFCs. And now the NBFC stool is going to have, some severe hobbling. It's, so it's going to create some growth challenges. So I think that India has a lot of headwinds, and the policy measures announced so far will have some moderate help on imports and therefore on the deficit. But I don't think they address the fundamental problem that oil is going up, and that's the biggest headwind for Indian current account deficit.
Okay. Catalin, actually, I wanted to get you on this. While you are a longer-term stock picker, what's your view of the Nifty Sensex levels itself, considering that crude has suddenly gotten worse than we were prepared for all of August, and there is this NBFC funding problem blowing up in our face? It was a big contributor. It might also stop domestic funds, which were a big support for this market.
Right. Yeah, I mean, domestic flows are definitely important and been important since foreigners been pretty much selling or been out of India. And I would say a couple of things. I think, yes, the market looks expensive on headline multiples, but I would also point out that profits to GDP is at a cyclical low. So as we hope the economy's momentum sustains, and there will be some capex cycle coming back that will finally, raise earnings, and I think that will give support to the valuations to where they are. I completely agree with the oil risk. I mean, in our view, oil is a short-term risk. Structurally, oil prices will not be above $100 or even about $90 12 months down the line. In between, because of the sanctions, it's difficult to have much visibility. But again, if you have a 2 years with the recovering profit cycle and this temporary pressure, I would say this is an opportunity to enter, not a time to exit.
Sure. Catalin, thanks a lot for joining us and giving us your view. Arvind, what's your sense on which way the markets could head from here? I mean, so far it hasn't even been a 10% correction that the Indian markets have seen. Do you think there's much more to go on the downside, or henceforth are we going to just see some time-wise correction in the market?
Well, I mean, unfortunately, I'm afraid that you could see a bigger correction because, as you were talking a few minutes ago, so far, most of the outflows have come from foreign investors, and the gap has been made up by domestic investors. I think with this whole NBFC situation, you're going to see domestic investor outflows, certainly from some of the debt mutual funds, but I think there could be some spillover effect on the equity mutual funds. And if the inflows slow down, forget outflows, if the inflows slow down there too, and again, the growth dynamics for the economy are probably going to be negatively impacted if NBFCs are curtailed in their level of ability to make loans. Therefore, I think the market, which is not cheap, at least by conventional measures, is likely to have some more of a correction, and therefore, we'd be a little patient in terms of putting money to work.
In fact, that was my next question, Arvind, because the headline index may have corrected only 7%. The BSE small cap index is now down 25% from peak. And I was just looking at some stat. The average listed stock on the BSE is down some 35-36%. What about those who would have been putting, money to work in mutual fund SIPs? You reckon there's a risk to slow down on some of these funds over the next, say, 3 or 6 months?
Absolutely, because, I think we're getting close to the point where people are going to start questioning. And again, it's very hard to tell when exactly do investors start getting nervous about their SIPs and the performance of their portfolios. But these things are very fragile. Confidence is a fragile thing, and it's been a one-way street. And if you start to get more and more kind of both performance-related shocks to investors and the broader news flow, which causes investors to turn cautious, and I think clearly HNIs will be the first ones to exit, and then you start getting these SIPs coming from more broad-based investors, and they start slowing down. And I think these things, unfortunately, tend to be self-perpetuating, and therefore our fear is that the dynamics of the macro environment are seeing a lot of headwinds, and these things unfortunately don't end up in a positive outcome. So we think that you're right that the mid-cap stocks are down, mid and small-cap stocks are down a lot more than 7 or 8%, and clearly there's a lot of money hiding in large caps. But we think the risk to the market is really the fund flow is now turning negative.
Okay, so what kind of falls would you expect? I mean, we still have an earnings growth story ticking. So what, does it go to 10.5, the Nifty, or even worse?
I think 10.5 is again, we tend to look at individual stocks, but
yes.
If you ask me, 10.5 is an easy kind of a target to think about, because the reality is that, again, that would still put the Nifty not below its long-term average in terms of earnings multiple. And then I would come back to one thing. I think there's no way that the growth story is as intact today as I guess I would have said a week ago. Because the NBFC story is really, really concerning to me in terms of what it implies for India's growth story. Because all you have left standing now that can keep going as strong as before is the private sector banks, and the NBFCs are going to have to pull down their breakneck, lending growth, and therefore that means that's slightly slower. I don't know how much slower, but we'll have to wait and watch. And uncertainty is not a time when people are feeling adventuresome and putting more money to work.
Yeah, we've seen that play out in individual stocks as well, right? I mean, the story of this month has been Yes Bank and that almost 40% decline. Do you think this lack of clarity on leadership is something that's going to keep the stock under more pressure, or would you use this as an opportunity to buy into it?
Well, I wouldn't have a strong view on Yes Bank. Clearly, there was a lot of controversy about, the current chairman, and therefore the change of the guard. Some might see as removing a question mark, but I think the other side of the concern is whether there's a lot of problems hidden that might come to the fore. We don't have a strong view. We are staying away from a situation like that where we feel like we don't have an edge on either way.
Okay, last question from my side, Arvind. Then so far people have been hiding in IT and pharma. In fact, the TCS stock or the IT sector, perhaps the best performing index worldwide now. You think it's overcrowded, or is it still the space to be in?
Well, it is certainly overcrowded if you look at the performance of some of the IT stocks. Pharma stocks don't look quite as overcrowded as the IT stocks, but clearly I think what you're now seeing is people betting on the global growth story with a weak rupee tagged along to it. So that seems to be the flavor of the moment, and we don't disagree with that. There are other ways to play it other than just rushing into IT and pharma in terms of some of the stocks that have sold off, which are auto-related, components-related, which are being hurt by concerns about global growth and about global trade wars. There could be some interesting opportunities there, but I think the large cap IT bellwethers like TCS and HCL are clearly are not undiscovered names. So they may be a little crowded, but my suspicion is that in this sell-off you will probably get better outperformance from some of the global-facing stocks versus some of the India growth-facing stocks.
Okay, that's a complete 180 degrees turn, isn't it? Thank you very much.
Yes.
Arvind Sanger, for joining us this evening for you and staying up for us. So 3 key themes which we will discuss throughout the day. Is the dollar going to get stronger or weaker? Because after all, the Fed has upped its GDP forecast for the US economy. A second theme, will the NBFC story bring down Indian consumption rates? And thirdly, are the import duties and other measures enough to remove the crisis in the currency market? We take a quick break. For the moment, we're going to discuss micros, the list of top 10 stocks that you have to watch today.